Hello, everybody. Welcome to Taking Care of Business. Today on the show, I'm joined by Nitika Vyas, founder and CEO of Aila Money. Nitika, you spent over a decade in institutional finance, working across investment banking, hedge funds, and brokerage roles before making the move into fintech with a clear mission to help close the gender wealth gap.
Yes. Firstly, thank you for having me on. And yes, I did. For much to my sins, I spent over 15 years in those roles.
Wow, you must have learned so much.
I did. Absolutely loved it. And it was a great training ground for what feels like I'm now moving on to living a life with more purpose.
Well, I mean, drawing on your experiences working both in, the highest levels of finance and growing up without access to meaningful financial education, I think it's just fantastic that you have founded Isla Money, which is often described as a money personal trainer, which I just absolutely love. So, just to explain a little bit more of the platform for the
Yes.
listeners. So it does combine behavioural science, technology, and human support to help people build confidence and take real action with their finances. And I mean, this resonates with me because I mean, I've always been really good at saving, but these days life just simply costs more.
Yeah.
And knowing what to do with money once you start having it is, I mean, it's not straightforward.
Mm.
So I'm really looking forward to unpacking how you think about money,
Yeah.
your insights into closing the gender wealth gap, and what it means for you to take care of business.
Thank you. And you're exactly right. You're not the only one that feels like they don't know what to do. I was in that position myself, which is why I've actually started this. I didn't grow up with money. I came from a low income migrant background. And because I worked in finance, I then was earning, but it was still a struggle to know what to do with my finances, despite having a maths degree, despite having my CFA exams, which I was doing at the time. There's so much jargon, which makes personal finance seem so inaccessible unless you come from that family that talks about wealth and building to start with. And that's what I want to change. I want to make sure that having the financial guidance and support you need to make your money work for you is available to everyone, not just the wealthy.
I've kind of alluded to it in my opening, but why was building Isla Money important enough for you to leave institutional finance?
Yeah. So I guess, like I said, I've come from that low income migrant background. I was always driven to do more, get out of that low income banding and just be settled for both me and my family. And I managed to do that both working at investment banks and then at hedge funds. But whilst working at a hedge fund, I came to see just how much access to information and advice the wealthy have to continue growing their wealth. It was almost handed to them on a silver platter. And I ended up feeling like, hold on, why do me, my friends and family don't not have access to the same level of information that could help us so much more and we needed it so much more? This was only then exacerbated during COVID. I was helping at mental health charities whilst also working at the hedge fund. And the number of people who called in who were struggling because of their finances, people who were thinking of taking irreversible decisions, especially women who couldn't leave bad home situations, really stuck with me. And at the same time, my worlds really collided because I was working for the second largest taxpayer in the UK. And you're just like, this isn't fair. And I want to use my skills to help more people, not just help the wealthy get wealthier.
So I grew up in the time of those Wonga loans. Do you
Oh
remember
gosh,
those? And the
yes.
interest rate was so high.
Mm.
And I had a couple of friends who actually took out some of those loans, and the interest on them was absolutely crazy. I don't know how long they were still paying those
No.
loans off for, but perhaps if they had some kind of more, financial education, they would have made
Those decisions.
somewhat irresponsible decisions because I'm pretty sure, I mean, they were taking out those loans for social reasons. Um, but yeah, perhaps if they knew the financial impact that that would have on them, they perhaps wouldn't have done it. I can clearly see that financial education at a younger age would be so beneficial.
And let's be clear, the places like loans do prey on those without money.
Yeah.
So it's almost a self-perpetuating cycle, because you're not having to pay those higher interest rates if you can, take an overdraft from your bank. But you only can take an overdraft from your bank if you're earning a certain amount. Wonga loans were a thing back in the day. The equivalent now is the buy now, pay later, which is getting a lot of people, and especially a lot of younger people.
Yeah, I've used a couple of those for big ticket prices when I moved flats
Yeah.
and I was furnishing it. So I was paying for a sofa, dining table, all that kind of stuff. And it worked out because I could, buy everything and
Yeah.
just pay it off monthly, which I did. But then I've heard stories about people, buying McDonald's on it.
The products themselves aren't necessarily the issue. The buy now, pay later, when it's zero interest and like split over 3 months, is totally fine. But what's happening is people are putting more and more stuff onto it and almost living and getting things now which they can't afford. And if you have too many of those buy now, pay later, suddenly you can't afford the monthly outgoings on them. And you haven't realised, because you've done one here for £50 a month, you've done another one there for £30 a month. And before you know it, like, what you're having to pay across them is actually closer to £300 a month, which is then inaccessible.
Yeah. So, talking now about the gender wealth gap.
Yes.
From your experience, why do women still end up with less wealth even when they earn similar amounts?
So this is something that bugs me. So first, we do know that the pay gap is real, but in certain industries like finance, like law, there is now a bit more of an equality, especially at the lower bandings. So you can earn the same amount as men. But what happens is twofolds. One is confidence. So it's your emotions around money. And two is an element of history. So the first one, let's go into your feelings and how you're taught about finance. Women are told that they are risk averse, that they aren't confident when it comes to their finances. And that is the narrative that society has been feeding for a very long time. So you speak to women, and most women will say, "Oh, I'm very risk averse," which is just not true. Society has told them that they're risk averse, which means that they are more likely to have a cash ISA and save rather than invest, because they then see saving as the safe option rather than investing. That will change the amount of wealth you can build over time, because saving won't grow your money as much as investing will. So there's one element of that. And it frustrates me so much because it's so untrue. Because women aren't risk averse. Women actually take the biggest risk in their life, in anyone's lives, which is giving birth to another human being. You're growing another human being, and literally it's leaving your body. That is the biggest risk anyone can ever take. So we're not risk averse. We just take more calculated risks. We're unlikely to do things without understanding it. And actually, the truth is, and lots of studies have shown this, that when women invest, they actually earn up to 1% more than men. So, yes, we're risk averse and we probably look into things a little bit more before we get started, but that actually suits us really well. And where we have this view of women being emotional, actually, when it comes to the markets, women outperform men because they're less emotional during the volatile times. And that's partly because they've done the homework up front and they have conviction in what they're invested in, that when the markets go up and down, they still stay invested.
Yeah.
So that's one side of it. And the other side is just the way society's been. Like, we have to take a moment to acknowledge that it was only 50 years ago in the UK, women were allowed to have their own bank account and their own mortgage without their dad or their husband signing off. So it's not that, we don't want to do these things. We haven't necessarily always had the role models that have done this, or it hasn't been as accessible to us. A lot of marketing for finance products, investing especially, has been geared towards men. There's been a lot of mansplaining in that space. And so women haven't always felt comfortable. And that's what we need to change. We need to change and make sure women know that they are welcome in this space, that there are products there to help them, and not in a mansplaining way, in a way that they understand, in a way that works for them. And generally what you find is women look at things more holistically, more emotionally, and we need to make sure that the products speak to them.
So you're clearly doing that with Isla Money. How else can we nip that in the bud?
I think the first step is actually having women talk about money. And I'm not talking numbers, I'm just saying talk finance. You can talk to your friends about money without saying a single number of what you earn. It's, what products are you using? Are you using an ISA? What interest rates are you getting on your accounts? What is your relationship with money? What is your earliest memory of money? You can start very light-hearted, but what you find is actually women are so much more comfortable talking about sex with their friends than they are talking about money. In fact, we're more comfortable talking about death as well. And that needs to change, because only when we work together and help each other can we make our wealth grow.
I was actually out with a friend on the weekend and we were talking about saving and investing and what the next 10 years will look like and, stuff like that. And I've always thought it was a good idea to put I don't know, 5 to 10% of your wage into your workplace pension, especially when you hit a certain age, because an employer usually doubles it or matches it.
Yeah.
What do you think about that? Because my friend was not of that opinion.
Full disclosure, when I was in my 20s, I had a company that chose that said that I could put into my pension or I could take that money as cash. 20-year-old Nitika took that money as cash because she didn't understand what pensions were and why they were important. But you're so right, because a lot of firms do pension contribution matching, and it is a no-brainer to put into your pension. It is actually the most tax efficient way of you investing in your future. And so, yes, you're right. Like, if you have got an employer who does pension matching, put as much as they match. So if they're matching 5% or 10%, always do that, because for you putting in 5%, your pension is actually getting 10%. And it's not only that, it's more tax efficient because you don't pay tax on that money if your company has salary sacrifice, and you don't pay national insurance on that money as well, which for anyone under 50k is 8%. You're saving that 8% and that's going into your pension. Even if your company doesn't do salary sacrifice and you're putting into your pension by yourself, so if your company doesn't do pensions, you still get the tax back. You instantly get 20% of your tax back. And if you're a higher or an additional rate taxpayer, you have to apply to get that money back. And again, this is stuff people don't know. And tax is the best way to actually be efficient. So there are tax efficient bandings, like, between 20 and 40% is at 50,270. There's a tax trap at 100k. If you earn between 100k and 125k, you pay 60% tax. Now, the legal and best way to avoid paying 60% tax is putting into your pension. It brings back your taxable allowance to 40%, and that's allowed, and the government allow you to do this. More people need to be using their pension. And don't get me wrong, I understand how a lot of people are feeling nowadays. It's like, why should I work towards my pension where I'm struggling to live day to day? But actually, what I can help you do is work out that actually putting into your pension is maybe going to be £100 difference to you today, and what goes into your pension is actually closer to £300. And when you look at it like that, that £100 today is worth it for that future you.
So what about for somebody, say, in their early 30s, so they're just coming out of their 20s now, with a modest disposable income, but a significant salary increase on the horizon? How should they think about their investing after they've thought about pensions?
Yep. So if you know you've got a salary increase coming, first thing I always say is know your numbers. Like, if this salary increase is going to take you into the next tax band, know what that means for you. Are you going from a 20% taxpayer to a 40%? Are you going from a 40% to hopefully not a 60%, but a 45% at some point? First, know the numbers and what impact that's going to have, because sometimes earning more doesn't mean you take home more. And also know what it means for your benefits. So if you're in your early 30s, are you getting other benefits such as child benefits or childcare hours? And what does that additional increase in income mean for those? and then look at how else you can invest. So pensions are a great one, but then there's also things such as an ISA, which is your individual savings allowance each year, which each adult has up to £20,000, and you can use that over cash or stocks and shares, and use that tax efficient account, because otherwise any money you are gaining, you are having to pay tax on the interest that you have in your bank account, on any investments you make, any dividends you receive, which is the money you get if you own shares as a part of their profit. So know the right ways of investing, and an ISA in the UK after the pension is the next best thing. If you're in your early 30s, the other one to highlight is a lifetime ISA. So I love the lifetime ISA. There is, there's two sides to this. A lot of people say it's not great. I am a huge fan. The lifetime ISA is 4K, which you can put in, which is a part of the 20K. You have to have opened your lifetime ISA by the time you're 40. And once you do, you can put a max of 4K into it each year, and the government top up 25%. So if you've put 4K in, the government give you 1K for free. You can choose whether that goes into a cash LISA or a stocks and shares LISA. That is free money. And they give you that 1K free a year up to the age of 50. Now, there is some restrictions on the lifetime ISA. You can only use it towards your first home, as well as then, or when you retire at 60. The main issues people see is, for the first time home, the value of the property is too low for London. But I didn't use it for my first time home. It came out after my first time home. I'm using it for 60. I have been putting into it for the last 8 years. I've got 8K free from the government. It's a no-brainer for me.
It's just a shame that the threshold for the house is so low.
Yeah. Don't get me wrong, the government now know this is low, and they are introducing a new equivalent of the lifetime ISA, which is coming around next year, which is going to be focused on just buying your first property. So anyone who's already bought their first property but under the age of 40, please open your lifetime ISA so you have the option to get the bonus for your 60 before you're 60. And then the new one is meant to be more flexible towards, the restrictions on the house prices and stuff. And don't get me wrong, like it was set up with the best intentions, but that restriction on the property price has stayed the same since 2017. That's the issue. If they just increased it with the house price inflation, then we wouldn't have this problem.
Yeah. From what I understand as well, correct me if I'm wrong, if you take it out and use it on your first home, even though it's out of that bracket, you don't get penalised for taking that money out and putting it towards the home.
You do. If
Do you?
It has to be within that the 450K.
Okay. Right, so I'm saving it then for my pension.
Yes. They might change those rules. They relaxed those rules during COVID. I do think that 450K is a ridiculous number for anyone in London, or actually now couples, because now people are buying their property later and are often buying together and seeing it as their forever home. And that's not necessarily an amount you can use. So there are changes coming.
So what's the biggest mistake that people make when they know that money is coming later?
So one thing I was told when I got salary increases that I stuck by is, if you can, pretend you didn't get a salary increase. So what this means is, if you can live off the money you currently have, before that increased salary hits your account, work out what you want to do. Be intentional with that money. And that has stood me well, because all of us have a level of lifestyle creep where, as we earn more, our lifestyles get more lavish. 20-year-old Nitika was not getting Ubers, was eating at McDonald's or Nando's. She wasn't going to better restaurants. As we get older, some of our tastes refine, maybe, and so they cost more. But make sure you pay yourself first. If you know you're getting an increase, work out how much of that you're putting towards your actual life goals, because it's very easy for it all to sit in an account and you just spend more. There's a general rule of thumb of 50, 30, 20, which is the net income you get each month. 50% of it should go towards your need expenditure, which is your travel, your rent, your mortgage, your food, your bills. 30% should go towards your wants. So that's going out, having a drink, going on holiday. And 20% should go towards your future goals. And so it is the smallest portion. But see, when you get those increases, how much you can put towards that 20%. You may not be currently putting 20%, like it may just be 5%. Can you get that up to 10? For some people, they're at 25%. It's just work out what that looks like for you.
So, Isla Money is described as a money personal trainer.
Yes.
What does that mean, and how did you go from concept to actually building that into the app?
So I call it the money PT because finance and fitness are very alike. And what the app does is help you, one, understand where you currently are, so your net income and your net wealth, and shows you where you rank across the UK and across your age groups. I then center everything around your goals, like a PT would do, but this is your life goals and the cost of them, all personalized to you. So you understand the cost of the life you actually want, and that's what everything is centered around. And then we help you achieve it with personalized financial education, action tracking of those goals, and then access to advisors and guidance as and when you need. So, for example, you may have put a load of life goals in, one of which was buying your first home. I can then help you work out how much you need to put aside each month in order to get the deposit together. The action tracker will keep you honest each month and go, have you put that money aside? Then, as you get close, I can then introduce you to a mortgage broker or a solicitor as and when you need and help you understand how much your mortgage payments are going to be. So, I really want to be that one stop shop which looks at all of your finances holistically, helps give you the financial education, but also the emotional tracking when it comes to finance.
So, you moved from institutional finance into running an early stage fintech,
Yes.
two very different decision making environments. What's changed most in how you make decisions when there isn't clear data or an established playbook?
It's the fact that you have to back yourself and follow your gut. Um, I don't think I had good gut instincts in my 20s. Working in finance and getting my background, and then working at a hedge fund, which was actually a hedge fund that had just launched, helped make me be in almost a startup environment. The big institutional banks taught me what rules and governance was, and it was very compliance heavy. What most would say is very red tape filled. So I got to learn how to stay inside the boxes and be very respectful of the regulations around finance and why that was so important. Moved to a hedge fund, which obviously still respected the regulations, but was a less regulated environment, but was a very startup dynamic where everything moved really fast, was growing really quickly. But I was doing what other people wanted me to do. And the startup space has been that same fast pace, but now I have to make all the decisions. Everything is on me and what I think is the best thing. The truth is, the hardest part is I am legal, I am compliance, I am marketing, I am the finance, I am the product developer. You have to learn everything, and no one else cares about the business as much as you.
Where have you felt like you've needed to troubleshoot or overcome challenges the most in the business?
Troubleshoot area has probably been product market fit. I hear lots of women say they want a product like mine, that they're not confident with their finances and they need help. I have offered a free product. The app is free to download. Do people download it? Like, how do you make a product where people know that they need it, but they close their intention action gap? And again, this is why it still keeps coming back to fitness. Everyone knows that they need to exercise and it's good for them, for their longevity, for their mental health, for their heart health. People know working on their finances is good for them longer term. How do you get people to focus on it now? And how do you engage people in the right way?
It's all about building momentum and pushing it like
Yeah.
you are doing. I see you all over Instagram and LinkedIn. And for all of my listeners, I will put a link in the show notes so you can download the app. I certainly have and think it's great. So, encouraging people to actively engage in their finances is, probably no small task. How do you build trust and help users take action rather than just passively consuming the app once they have downloaded it?
Yeah. So this is where it comes back to product market fit.
Hmm.
And, you know, as a startup, you can be nimble and you can get feedback from your clients very quickly. I first started actually on WhatsApp, where I got feedback from clients almost straight away, because if there was something they didn't understand on one of the messages, they would message saying, "Hey, I don't get this." Um, it's knowing when to pivot and knowing how you build trust. So, I don't come from a marketing background, but I have then come to learn, when it comes to marketing and social media, someone needs to see something 7 times or see you 7 times before they start trusting you. How do I build trust in the app? Well, actually, what I've learned from my community is an app only approach isn't what my community is looking for. They want a space, a safe space to talk about their finances. So I'm building the community around the app. And actually, that's why I started offering what I call the 75 money courses, which is a group of people coming together once a week for 11 weeks, for 75 days. And each week we spend 1 hour going over a different area of your finances together. It is a safe space where you're not only learning from me, but from each other's experiences. And you have a group of women you can talk to about your finances in a safe way.
So, these people arriving at Isla Money with very different relationships to money, how do you design the product to meet these users where they are?
Mm. Um, so I've been very focused on the personalization here, because I've seen it for myself, and I'm sure you've seen it. We're at different stages of life. I'm late 30s now. Me and, say, my three best friends are at very different stages, have different priorities, different focuses. And so the personalization is key. We can't just say a 25-year-old needs this, a 30-year-old needs this, because we're all choosing to do life differently. And so the app has to meet you at that level. And also your financial education levels may be different. So I allow you to choose for that. So one, you get to personalize your life goals. So you get to choose the goals that matter to you. For someone, that might be they want to have children. For another person, it might be that they want to go traveling for a year, or that they want to change jobs. There is no judgment. You get to choose what those goals are. One of them, in fact, is leaving a bad situation. Now, whether that's a job, or some people have downloaded the app to get them ready for a divorce and make sure that their finances are ready to leave a situation. There is no judgment. It is personalized for you for your goals, but then also the education, there is a level of personalization. At the start of the investing module, I asked, do you want to know it all, or do you want a light version? And depending on that, I teach you different amounts. Now, if you do the light version, you can still go back and do the full version at any point, but it's understanding that not everyone needs to know everything. People may just want to get started and want to know the best ways to get started.
I think that your 75 money community, where I'm assuming people hear other people's stories, is such an eye opener, because I live my life, and I have my friends, and we are, as you mentioned, at different stages of life, but we're all kind of similar. So to go in and speak to women who are living completely different lives and going through different things with different problems, um, I imagine that that is a great eye opener and a trigger to maybe think, maybe I actually need a rainy day fund.
What I found is, obviously, the people who've joined these groups, there's no kind of age element. So in some of them, we've had a 23-year-old, or actually the youngest we've had is a 19-year-old, and she's been in the same group as someone who's actually in their 50s.
Yeah.
And for them, it's like it's all well and good me saying 3 things I regretted not doing in my 20s, but hearing it from a group of women being like, oh, I really wish I'd done this before, it just is a different motivator to just me.
So, what is one money management problem you consistently see in people with a lot of money, and people with very little money?
There is a common thing, and it's very UK wide and actually worldwide: subscriptions. There is so many unused subscriptions everyone has, from whether you're low income or high income. It's very easy for companies to sign you up on, say, a 3-day trial or 3-week trial, and then charge you for a year's subscription without you recognizing or realizing. Um, it's something like there is 3 trillion worth of subscriptions in the UK that are unused.
That's crazy.
And actually, the government even recognised this was a big problem and had started looking at doing a white paper on how do we solve this problem. It hasn't got further, and I have chased up on it a few times, because it's unfair that people have these subscriptions and, companies make it purposely hard to get out of them. So that's one of them. The other one is getting started with investing. Investing has felt like something that's so inaccessible for most. Unless you have a financial advisor, people think that they can't start investing. Now, that's not true. Over the last decade, so much has changed, and mobile phones, internet banking has made life easier, that you can start investing with as little as £1. You don't need to know the ins and outs of how to invest. You can use robo advisors who can do all your investing for you. And actually, what I find is those people that don't come from wealth don't necessarily know those options are out there because it's still not been targeted towards them.
So, my final question I have to ask is, what does it mean to you to take care of business?
So, taking care of business for me looks like making your passion as well as the impact you want to make in life work together. So, previously, taking care of business in a corporate world looked like just doing what was needed to meet your end of year goals. Now it's about what impact can I make on the world? What difference can I make by making my business work for others as well as me? Like, when it comes to the gender wealth gap, it is worth noting 72% of women do not feel empowered to act on their finances. You are not alone if you feel like you don't know what to do with your finances. And the best way to get started is to have a conversation, whether that's with me, with your friend. It's not just you, you're not alone, and there is help out there.
So, if people do want to have a conversation with you, how do they do that?
They can get in touch via social media, LinkedIn, Instagram, TikTok, download the app, as well as getting in contact with me using my email address, which is nitika@ailamoney.com.
I will put all of that in the show notes.
Thank you.
Thank you for coming on.
Thank you for having me.
And thank you for everybody for tuning in to another episode of Taking Care of Business, and we'll see you back in here next time.